Can other countries use this recipe to their benefit? You know, can Italy or Azerbaijan or Ecuador say we're going to put tariffs on imports now and we'll make money that way and maybe reshore? Or does that logic only apply when you are the largest and biggest economy in the world?
That's a fantastic question, Cyril. And I'm glad you asked it, because I think in economics, every economist is trained with the notion that tariffs are terrible because they distort resources, they raise prices, and make things worse off for the country imposing tariff. But in the case of the United States, the way that tariffs are being used is slightly different. The United States is not a small economy and a price taker. It is a large economy with a very attractive domestic market. So what it's telling the world is to say, if you want to come sell your stuff here in the United States, there's a price of entry, 10%. And that's to allow you to access our marketplace. But you get a better deal if you are able to shift some of your capital to the United States, where the rate of return on capital is really the highest, because the United States is a source of innovation. And by placing capital here and investing in the United States and producing here, you will be better off in being able to have not only no tariffs, but you will also have the benefit of opening up your own markets to American investments coming into your country. So what President Trump is trying to do is to lower tariff and non-tariff barriers in particular for all countries. And I think other countries can do this by again, opening up their economies for trade. And in those sectors where trade in goods or services is not feasible, they will then import capital and labor into their countries and produce there. And that kind of reciprocity, a complementarity, I should say, of factory movements and goods movements, I think, is the new wave of global trade going forward.
William Lee, Chief Economist at the Milken Institute. Thank you very much for that.
Thanks for having me.